When I first got into investing, I looked through a list of a bunch of different influential investors, and the one that stuck out to me the most was Warren Buffett. I read everything I could by him, I watched all of his press conferences, and today I have an investment portfolio of over $400,000. But even more than the amount in my investment portfolio is the fact that right now, at the time of this video, we're experiencing a pretty big market correction and bear market, possibly going into a recession. But I have no stress, I know exactly what to do, and I'm not freaking out at all because I listened to this very, very simple advice that I'm going to give you guys today in Warren Buffett's top 10 investing insights. The 10 are going to be his thoughts on holding cash, market conditions, diversification, risk, his idea about high IQ, the best investment, asset allocation, day trading, growth stocks, and his thoughts on a market correction. I'm Professor G, and I've compiled a couple of his videos along with a bunch of his quotes, and I'll give you my thoughts on what he means by each one, and how I use it personally in my investing, and how you might be able to as well. Number one is about Warren Buffett's thoughts on holding cash. So basically the question that was asked to Buffett is, that whenever you look online, that some people have put together some type of asset allocation that looks like you should have 50% in stocks and 30% in bonds and maybe 20% in cash. And so Warren Buffett responded to this by saying that you should never just have cash just because you should have a set number of 20% or whatever it is in cash. He said for him and for somebody who's well off that they should keep very little, if any, cash. Most of the money should be working for you, because that's just way better. But he did say that some people should have some cash, and he goes over it well in this short video here.
It depends on their personal situation of it. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. If your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you don't really need any cash.
The next one is near and dear to my heart. And that's all about market conditions, which is huge right now because everyone's scared about a possible recession and that somebody's saying like there's a 50% chance that this may happen. And so Warren Buffett quickly says to give up something that you do know and that is profitable for something that you don't know and won't know. It doesn't make any sense to us. And that doesn't make any sense to me either. So basically what he's saying is you do know that this company is a good company, or you do know that this index fund is a good index fund long-term to hold. If you take the advice of people on TV and they're saying don't buy these things that you know are good because the market's going to drop or it possibly could drop, to him that doesn't make any sense. And as long as you're going to be holding this long term and you have a long-term mindset, then anything that happens in the next year to 5 years doesn't really matter anyway. So this one's been big for me in my investing career over the last 10 years or so, and specifically now as we're going through this market downturn, because it's keeping my stress levels very, very low. Number 3 is all about diversification. Let's see what Warren Buffett has to say about that.
We think diversification as practiced generally makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
So number 1, he did say that for most people, it is a good idea to own the whole market. In many interviews, he talks about the fact that 95 to even 99% of investors should just own VU or VTI, which just tracks the whole stock market or the S&P 500. But in number 2, what he was talking about is that if you do know how to analyze businesses and you think that there's a list of here's the number 1 business that I want to invest in and number 2 all the way down to number 50, why would you put money in number 1, number 2, all the way down to 50 if you truly believe that that's the order that they're in and that they will be for the next 30 years? Why not just put all of the money into the top couple won. So that's why for me in my investing, most of it just goes into VU, as I talk about in this video. And honestly, for most people, you could just invest in that one thing forever and be totally fine. So I have a foundation of VU and some other index funds, but then I have a total of 5 other companies that I invest in that I think are going to be good for the next 30 years. And so my diversification isn't too crazy either. Number 4 is all about risk, and it's one of my favorite things that he talks about because it's always short and to the point. To him, market volatility is not the same thing as risk. So just because an asset goes up and comes back down and whatever, that doesn't mean that it's a risky business to hold. The thing that he thinks is risky is if you don't understand what you're investing in. And so if you've watched any of my videos or been in any of my classes, you know that my number 1 rule for investing is to only invest in 100% what you understand. Number 5 is all about IQ and being smart enough to invest. One of my favorite quotes on this from him is, "It's a temperamental quality, not an intellectual quality." That basically means that you don't need to have tons of IQ and be the smartest person in the world to invest. You just have to make sure and have an even-keeled temperament and be able to ride it out when things happen. As long as you start out with investing in what you 100% understand, you're investing in something that you're investing in for a reason. And so if the whole market drops for a certain reason, that doesn't mean, oh, that company's bad now, so you take the money out. So you keep your money in there, you possibly keep buying in because now it's on sale, and then when it comes back up, you get to reap the benefit. Where everyone else panic sold, and so it's not about being smarter than other people, it's about just having a stable personality through these market dips. Number 6 is all about what the best investment is. And what he said is no matter what, the best investment that you can make is in yourself. A lot of people think that that means that you go from having no skills to then learning something and now you have a skill and so now you can monetize that. That's great, but for those of you that are watching this channel, I tend to think that you guys already have some skills. And so to go from having some skills to having even more skills, that makes you even more valuable. Like if you're a super analytical person, or if you can do graphic design very well or something already, if you can now add to that something like communication or networking or something that possibly you've neglected in the past, you add that one quality, that's just gonna make your business go even stronger. And because of that, you'll be able to make 50, 100% more money than you are right now. So invest in yourself, invest in learning something different, a quality that you don't already have, and that's just going to level you up. This next one is one of my favorites, and it's when he talked about asset allocation. We talked a little bit about this earlier when I talked about the cash position that you should have, but basically what he's talking about here is that when you look online and it says something like you need 65% stocks and 35% bonds, and then somebody else says, no, it's way better to have 60% stocks and 40% bonds, and somebody else says, no, it needs to be 30, 30, 40 or something like that. What he's basically saying here is that these are just people putting things out there, trying to make it so that the regular public, you and me, get confused, and because of that confusion, then we think that we need a financial advisor. Now, quick disclaimer, I'm not a financial advisor, and a financial advisor is helpful if you totally don't understand these things and you want to make good use of your money. But if you start to do your own research and you start to understand things that might work really, really well for you, then maybe paying somebody else to do something that you're totally capable of learning and doing on your own maybe isn't the smartest thing. So asset allocation is just all about what's best for you. For me, my asset allocation is a little more risky just because I've paid off a bunch of other things and I don't have any debt. So it's okay for me to risk on something that's high risk, high reward because I don't have to pay down a huge credit card bill. So for me, it wouldn't make any sense to put half of my money into stocks and half of it into bonds that's very safe because I'm already in a safe position. So I can put more of it into stocks or cryptocurrency or real estate or other things. And that's what I do. But still with my high risk, high reward type investing, I'm not gambling. And number 8 is all about day trading. So let's hear what Warren Buffett has to say about day trading.
Desire of people to gamble, and they gamble in stocks, incidentally, too. Day trading, I would say, and often came very close to gambling as defined. People like to gamble, you know. I mean,
So his stance on day trading is the exact same as mine, which is that it's a little closer to gambling than I'd want it to be. When I invest in something, my idea is that I'm putting money into something that I think will grow long term and will produce something that's worth more than what it is today. I do have a lot of friends that make money in day trading, but I also have a lot of friends that have lost a lot of money in day trading. So that's about all I'm going to say on that one. Number 9 is all about growth stocks. Now, if you've been in the investing world for any amount of time, you know that there are people that think that value stocks are the way to go, and there are people that think that growth stocks are the way to go. And the cool thing about Warren Buffett is that even though he is seen as more of a value investor, he says that growth stocks and value stocks should be the same thing, because long term, your company that you put money into at the time of getting a value stock should continue to grow. And so by definition, that was a growing or growth stock. He says that they don't have to be different than one another, and they usually aren't. Now, the problem that I see a lot of times with growth stocks, especially things like Tesla or some of these other electric vehicle or augmented reality type companies, is the idea of hopium, that this thing should go crazy and that everybody's going to love it and that we're going to totally replace something with another thing, and so you want to invest in that other thing. The problem is that you can't just go off of your emotion and your hope. You have to still do the research and make sure that the fundamentals make sense, the numbers make sense, the CEO is good, the management is good, all of the different things that you want to do rather than just the exciting nature of the company. Last is this idea of timing the market or waiting for a market correction. I can't tell you how many times I get this question in my classes and also through the seminars that I do on investing and personal finance and even with my clients. I get the question of, shouldn't I just wait till it goes lower? Well, the answer is if you knew exactly how low it was going to go, then yes, you should wait because that's the best time to buy. Problem is, we have no idea how low it's going to go if it's already at the lowest. And so Warren Buffett's answer is the same as my answer, which is that you cannot wait for a market correction for you to make that investment. Let's watch.
Unless you find the prices of a great company really offensive, if you feel you've identified it. And by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean,
So basically just taking into consideration all of the other insights that I've shared in this video, and if you think that you have a good solid company that you 100% understand or index fund that you totally get, then it shouldn't matter when you put the money in, just that you're consistently putting some money in and investing in this position. And just keeping it even if it goes down or it goes up, holding it long term and watching it grow. That's how the wealth is made. For more on this and how you can take all these steps and actually invest in making life-changing wealth, watch this video now.